Welcome back to another week of the Educated Home Buyer Live. This is where Josh and myself answer your mortgage and real estate questions, update you on the economy, and help you guys become educated home buyers. Josh, welcome to the show.
It's another day in paradise, Jeb. We're having fun.
It always is, Josh. It's always paradise when we're doing loans. Do you know I've been doing this over 4 years? 4 years on this thing. I looked a moment ago. My God, that's a lot of questions, a lot of time spent online. So hopefully you guys find value in this. We're going to update you, like I said, on everything that's happening. We'll dive into that in just a minute. But before we do so, let us know where you're watching from. If you're a first timer, let us know that. And more importantly, start putting your questions into the chat so that when we're done talking here about what's going on in the economy, we can dive right in to your questions. So, Josh, where do we like to start? We like to start at inventory, don't we?
Always.
Inventory this week actually fell. It fell from 734,290 to 732,410. Is that a shocker? Probably not. Getting up towards the time in the year where inventory is going to pull back a little bit. Obviously, natural disasters, a lot of that thing, stuff that's happening in Florida and some of these other markets limiting property coming to the market. So that's obviously slowing some things down as well. But more or less still continuing where we've left off. No, real changes in the patterns as of yet. But we'll continue to talk about that. Now, we like to look at Orange County and Huntington Beach is where we are. Orange County grew to 3,659 listings, pretty much at the top of what we've seen this year, Josh. And Huntington Beach sitting at 240, just below that. Both up week over week. And what I will say is that even with that, the market is still continuing to slow down. Active inventory. This again is pulled from calculated risk. This is, I think, the second week in September, the look at the market. So that is about 2-3 weeks old. But at that time, you could see, looking at year over year, we always like to go there and then back to 2019. We had 3 markets that were back to 2019 levels. Denver up 20% versus 2019. Jacksonville up nearly 52% versus that. And Nashville up nearly 15% versus 2019. All the other markets are up year over year, but still down when compared to 2019. New listings. So new listings, 62,876 new listings with an additional 10,000 that sold immediately. Now, the positive news here is that we're still, seeing an increase even with the significant listings in Florida that have been removed over the past 2 weeks. So we've got listings coming off to the market, new listings coming on. So even with all that said, the market's still kind of chugging along, giving more opportunities out there for buyers. And again, this is the same type of chart, but just looking at new listings. Grand Rapids up compared to 2019 and Jacksonville being up, like we mentioned a moment ago, also when compared to 2019. This is that week over week chart. Went from 734, as I mentioned, down to 732. Our high at the moment is still 734,290. We haven't peaked yet for the year. Probably going to be pushed closer to November, mid-November, when we start to see that seasonal decline. But it's hard to say at the moment just because things are still somewhat unknown out there when it comes to rates and seasonality. The seasonality is not in full effect at the moment. Pending home sales at 350,455. Compare that to 326 in 2023 and 351 in 2022. So about 1,000 more home sales, and we're going to actually surpass where we were last year. But last year, remember, we were heading towards an 8% rate. So it's also important to understand where you're coming from. Rates aren't at 8%, but they're also not at 6% where they were a couple of weeks ago. I think as of today, probably sitting closer to 6.65, which Josh will update us on here in just a minute. And the last thing we like to look at is percent of properties with price reductions, currently sitting at 39.62% compared to 38% in 2023 and 42% in 2022. In the past 2 years, price reductions increased all the way into December due to rising rates. However, in normal markets, price reductions usually top out at the end of October. So it'll be interesting to see if that happens. So, Josh, what are we looking at here?
Well, we don't generally like to have slides with just a bunch of text on them, but we keep coming back to data goes one direction for 1, 2, 3 months, and then we get this surprising data going in a different direction. I keep saying, coming back to the idea of a head fake. a head fake that things are better than we thought, things are worse than we thought, things don't seem to continually go in a direction. And this isn't a newsletter, it's a free newsletter if you guys want to subscribe. John Malden publishes it every Saturday. You can just sign up and it drops into your inbox. Jeb thinks he's overly pessimistic, which he may be, but this was a quote that resonated with me with what we've been thinking about, what we've been talking to you guys about here on the show. It says, I'm beginning to wonder what the years of extreme intervention since 2008 did to our indicators. Does the data still mean what we think it does? Maybe not. And that's on top of questions on whether the data is even being measured correctly. So again, we talk about not being conspiracy theorists, but the data just is goofy and not adding up. Very low responses to surveys, which a lot of this is collected on the initial data through surveys. And then does the data still mean what we think it does? Because everything I've learned and experienced in 50 plus years of watching the economy tells me not to expect a soft landing, but maybe that's because I've never actually seen one. So we sit here week after week. I am biased towards believing that interest rates are going to go lower, that the impacts of everything that led rates lower for 40 years did not suddenly get turned upside down. If you remember heading into COVID in 2018, 2019, the Fed was releasing statements like, we are open and willing to tolerate above trend inflation for an extended period of time so that we can average 2% over the long haul. They had a very hard time getting inflation to 2%. And now we have pundits telling us they'll never get it back to 2% when nothing other than massive money printing, increase in money supply at the beginning of COVID, and then decreased or massive supply constraints so that there was a bunch of money chasing way too few goods that pushed inflation very high in the near term. And this whole talk here, Jeb, the extreme intervention since 2008, they kept interest rates artificially low for the better part of 15 years and extremely artificially low through COVID. And it's led to distortions in asset prices. So looking at your charts, Jeb, everything that I look at, it still tells me that, no, you're fine. Still tells me that we have this weird point where people want life dictates that they should buy, sell, move, and we're locked in because we can't afford to move. So we see low amounts of sales, low amounts of every type of activity that requires financing. But with that, let's take a look at this. I wanted to show you guys two charts. I drew this earlier and I sent it over to Jeb and I said, Jeb, you chart this up differently. Take a look and send me back yours. So the teal line was what we are. The teal channel is what we were all enjoying for the better part of 3 months, pretty much straight down at a pretty steep slope. So rates dropping, yields dropping rather quickly. So this is the optimist's view of it. We've broken up out of that channel. But if you step back, you can draw another channel that says, less of a steep slope, more of a slow and gradual downtrend, but still intact. And this could very well prove to be true. But again, another look, Jeb has this drawn up. This is a weekly chart going back to 2021. So you can see yields increasing pretty much incessantly for the better part of 3 years. But we did kind of hit a peak and we've had 2 lower highs. And if this is the next lower high, meaning that yields did not go back up and create a new high, it's creating this pennant. You can't really see it, but the top down trending blue line, the bottom up trending blue line.
They're all blue lines, Josh. I like blue lines.
Yes, Jeb likes confusing things, so he just puts blue lines everywhere. So I said the top descending blue line and the bottom ascending blue line. Jeb, I had to get very descriptive because of your inability to color things. But that tells us we're going to get a breakout at some point. And it's instructive to look at the way other people are seeing things or thinking of things. That's why I asked Jeb to do this, because when I look at that, I go, that tells me until we get a definitive breakout below that ascending blue line there at the bottom, it's really hard to say that we have a new downtrend in interest rate. It's looking constructive. It looks good, but every time we get near the bottom, it's kind of held there in terms of the yield. So that was my thought. Wanted to point out, you guys have all seen, and we have some comments in here already that, hey, Fed cuts last month, almost exactly a month ago, 50 basis points, rates improved for a couple days, and then we've gone straight worse. So this is from Barry Habib, previous guest on the show, mortgage expert. He's been basically 7 of the last 10 years, most accurate predictor of home values and interest rates. But another comment here. This is not an unusual phenomenon. We've seen this happen in almost every rate cutting cycle except for 2019. And a lot of the reason why is investor psychology. So you guys think about this. Investors believe we have a greater chance of avoiding recession once the Fed starts cutting, that soft landing that Malden says he's never seen, which causes them to invest in the stock market at the expense of bonds. Stocks have done very well all year, but definitely since the Fed cut. And the Fed cutting causes some to fear inflation rising once again, which causes bonds to temporarily sell off. And we've seen that. People saying we also get this hot jobs report. Hey, jobs, the economy is doing well. High GDP, strong jobs report. Inflation's going to take off because the Fed's crazy. They're cutting again. But the Fed is cutting for a reason, is because they're seeing the economy slow, and that helps the bond market and inflation come down. And each of the last instances where yields initially rose, they eventually fell much lower, and we don't believe this time to be any different. So that's kind of the charts we're looking at. It's kind of the conversations that Jeb and I are having on the back end. So in light of looking at this, the data that's going to be coming in, we get a look tomorrow at retail sales, which could be distorted to the upside because of people stocking up on supplies before the weather events we had here recently. But we get the weekly claims. So again, another previous guest of the show, friend of the show, Logan Mojashami, that dashed line way there up at the top. He says until we get weekly claims consistently averaging on a 4-week moving average, 312,000.
323.
323. Okay, so 323. That we have not seen the jobs market break to the point that would really indicate a downturn. So when we look at this, we saw all the way through 2023 claims rising, and then this red line, they go way back down, back to where they were in the middle of 22. We're seeing them rising again, but even on that moving average basis, it's not sort of the straight line up that we want. So slowing, but not weak. Unemployment at 4% is a historically very strong jobs market, but we have people not leaving jobs, not getting big raises when they leave jobs, not getting fired. So it's sort of this in between, sort of Mike Simonson, Jeb over at Altos Research, in his weekly YouTube update this week, he compared the two. He said homeownership is like the jobs market. People aren't quitting, people aren't getting fired. People aren't selling houses. People aren't buying houses for largely some of the same reasons. You had thrown this in here, Jeb, and what struck me with this, California is often canary in the coal mine in terms of we see trends in unemployment, lots of trends, but definitely in employment before other parts of the country.
Yeah, no. This is a chart. If you guys are familiar with Sacramento appraisal blog, Ryan Lindquist, he was nice enough to send me this chart. He knows we're in Orange County. He does an awesome blog. If you're in Sacramento, you should definitely pay attention to it. Keeps you up to date on everything in the market there. But just basically showing us, where the averages are in California with regards to unemployment, where it is where we are in Orange County, obviously below the California average. But I just thought it was another piece of data to throw in there just to show you, we're definitely off the bottom, but and seem to be trending a little bit higher in unemployment. We're kind of the dog the tail that wags the dog to some degree when it comes to California and unemployment. So it'll be interesting. As we're continuing to climb, does the rest of the U.S. also see the same thing?
Absolutely. Wanted to point out here, so you see the big uptick in applications over the previous few weeks as rates dropped. We had a big wave of refinance activity come in. The people that bought the last 12, 24 months at the higher interest rates, taking advantage of rates moving lower. And as they've popped back up, they're very sensitive to that. So 0.5% off of the bottom, many people feel like they've lost that window or missed that window. And we see applications down 16% this week. And it was like 27% on refis and 3 or 4% on purchases. But if we look at this is an index of mortgage applications to interest rates. So if you look at the orange, that's the interest rates. And we see them coming down over the last few months. We see applications going up. We're going to continue to see that. So unfortunately, for those of you waiting for better affordability, unfortunately for those of us that make our living selling houses, doing home loans, volume is going to remain low until we get affordability to a better point. And for all the reasons that we've discussed before, interest rates are really the big lever that is going to move. I don't think we're going to see a big spike in real incomes that would make affordability better. I don't think we're going to see a big drop in home prices that would make affordability better. So the big lever we have to move is interest rates. When they moved briefly, if you go back and look at those charts, Jeb, we've seen increases in home prices over the last 2 months. We've seen increases in sales activity, decreases in inventory in most markets. Obviously, this isn't homogenous everywhere across the country, but when you look at that, it's not hard to see from the data that the market is really sensitive to affordability and the fact that interest rates are the only thing that can move it in the near term. I don't know if you saw this, Jeb. Nearly a quarter of prospective first-time home buyers are holding off until after the election. Now we are what, 3 weeks out from the election. So if you haven't bought now, if you haven't done anything yet, probably not any harm in holding off. But when you start reading into the data, the thoughts are, I'm waiting for more Fed cuts that will make lower interest rates. So we've killed that ad nauseum here on the show, that the Fed does not directly control interest rates. It's going to be the direction of the economy and inflation moving forward. But the second piece of it is, Kamala has a great idea for giving away free money to make homes more affordable. So giving people free money to buy things rarely makes them more affordable. Part of how we got into this problem is what Malden said with that quote I led off with. From 2008 to now, we've had massive government intervention, thumb on the scale. Asset prices of things that are purchased with debt financing are way higher than they should be. So please, however you vote, this isn't telling you how to vote, because both candidates would love to give away free money for their pet causes. It's to say, don't hope for this. Our hope would be 50 years of the government staying out of the market, and it might resolve itself. So in light of that, I went with a little bit of different chart here, the way Mortgage News Daily presents it. 663 on the 30-year fixed, up about 0.5%. FHA 608, up also about 0.5% from the lows, and VAs are super similar. And those PITI payment or principal and interest payments are there at a 400,000 purchase. And I think from the most recent MBA applications, the average is about 398 on the loan amount.
Yeah, and I think we've pointed this out before, but well, I know we have, is that the rates you're seeing here, if you got good credit, good down payment, your chances are you're getting a better rate than what's being quoted on the screen. But if you want to go through the process, want to talk to Josh, all of those states that are highlighted in red here on the map of the United States are states where Josh actually does business himself, and all the blue states where we can refer you to a partner of ours who can guide you through that process. So if you're going through the process, need a second quote, refinancing, purchasing, whatever it is, reach out. Let us be a source for you, talk to you, and see if we can ultimately get you to the finish line. A lot of you guys reach out. We're helping a lot of you guys. And for that, we're very thankful and appreciative of the support. So, Josh, let's do this. We don't have a ton of questions in here at the moment.
This is a trend. They all hold off to like the last 10 minutes of the show to start typing in questions furiously.
So while you guys are typing in your questions that you want answered this evening, I want to talk about the magic mortgage rate, Josh. This episode is labeled or titled "This Magic Mortgage Rate Will Unlock the Housing Market." Last week we showed that if rates come somewhere between that 5 and 5.5%, that's going to unlock inventory. Now, it's been proven by home builders to some degree that if we can get rates in that mid 5% range, it can actually move sales. And how do we know that? Because at the time when interest rates were at 6.5%, 7.5%, builders were actually buying down rates for a lot of buyers out there at the moment to 5.5%, under 6%. And guess what? It was moving the market. Sales in new homes were actually surpassing that of existing home sales. So they have an idea of what's going to unlock some of that inventory. So you truly need to see interest rates between 5 and 5.5 in order to see more and more inventory come to the market, in order to get home sales kind of moving again and get the market kind of flowing. Reality is probably not going to happen. You're not going to see it. You're probably not going to see it in 2024.
Well, hold on, Jeb. Hold that thought. I don't want to cut you off, but you say that, and I think it's a complete thought in your head, but I've heard you say it like 3 or 4 times, and I misunderstand you when you say it. When you're saying it's not going to happen, it's likely we're 2.5 months from the end of the year. If you think something massive is going to happen between now and the end of the year, probably not. The end of the year, rates are going to look very similar to where they are right now. He's not saying, don't let me put words in your mouth, but he's not saying, oh, it is not going to happen. Saying it's
No,
not
I'm
going
saying
to
it's not
happen
going to
in the near
happen right
term.
now. And that's where I was going with it, is that it's not going to happen in 2024, in my opinion. Could it happen in 2025? Absolutely. I think there's a high probability that it probably happens in 2025. But until then, you've got to measure where you are in the market. Like if you were somebody that was sitting on the sidelines waiting, the Fed cut, rates went down, and you said, well, that's not good enough, I'm going to wait. That's what happens in cycles. When home prices come down, when rates come down, it's this waiting. And then the waiting continues to wait because I want something better. I'm not satisfied with this. I think it's going to continue to go lower. It's going to continue to go lower. Guess what? It's going back up. Well, I'm not going to chase it up. I'm going to stay here and wait until it comes back down. Well, guess what? Those people end up waiting forever, eternity. Now, this isn't a push to get you to go buy a home. It's just market psychology. That's how things work. So instead of hoping for the best rate or trying to pick where the best rate is, get a number that you're comfortable with, a payment, a budget, create it all, and payment, fantastic. If a better opportunity presents itself down the road and you can refinance, even better. But that's the way you got to think about it. You can't be trying to pick the top of the bottom. Is fun and as easy as it sounds with all the experts out there online. Trust me, it's not that easy. You got to get lucky, and that's what it is. The people that hit the tops and the bottoms aren't experts. They're lucky.
I want to say what you said in just a different way, and sort of dovetailing with what we've always said in the 4 years of sitting here and answering you guys' questions is time your life. Don't try to time the market. If you sit here and go, okay, everything lines up, my relationship's in a good spot, career's in a good spot, credit's in a good spot, saved money, I'd like to buy, but I'm going to wait for rates to go lower. Bad decision. If you're sitting there and going, hey, I would be pushing the issue or forcing it now, then that's a very good reason to wait
Sure,
and hope
absolutely.
that rates get better. But to say you're going to time it or step in at the right time, probably the best example, Hayden, and of course I'm going to draw a blank on his wife's name. They've been watching the show almost from the very beginning. They bought at the very end of 2023. They started looking in early 23 and prices went up, rates went up. Things got way less affordable for them. But they've been able to refinance twice. We caught the dip at the beginning of this year and did a no-cost refinance. I think we went from 7 3/8 to 6.875 roughly on a $650,000, $700,000 mortgage. And then we just did it again. I think we got into 5.85 on a no-cost refinance. And if and when rates move lower, they're going to have that option to do it. So we haven't done no costs on the loan. They're in California, so we have lower closing cost state. It's a bigger loan. It's easier to do that than it is if you're $300,000 loan in Florida where the costs are higher. But they've been able to say, the time is right in our life. We can afford this, and I don't like the affordability level, but I'm okay with it. And I have the hope or option of taking advantage as rates move better. And they've been able to do that. And he referred over one of his friends here earlier today that bought in the Sacramento area earlier this year. Same thing, at a peak in interest rates. And we have probably about 0.5% of savings on the table on a $495,000 loan with no cost. So that it's not a set it and forget it type of market because rates are high, they're elevated, people don't like that. We're going to get little windows of opportunity, but you're going to have to be nimble and pay attention, and hopefully working with advisors that are helping you to do that.
Absolutely. So with that, we don't have a lot of questions, Josh. It might be a short show tonight.
Could be.
Jessica came in with a question. Says, hello, she's from Phoenix. Seeing more and more of these iBuyers digging in and holding on to homes or houses and completely stopping price drops on their overpriced properties. Is this a bad sign? No, not necessarily. You got to understand, like, what's the motivation of a company that's holding a ton of property, right? They're publicly traded. They don't have the emotion that a homeowner who has to move, has to sell their house in order to buy the next home has, right? The motivations are a little bit different. They can go longer. They can hold on to things that are overpriced. They can write off losses. They can do a lot of different things that you and I as a homeowner aren't. I guess we are able to do to some regard, but for the most part, we're not able to. So no, I don't think it's a bad thing. I just think they're probably gauging to see what the market's doing, right? This is the time in the year, understand, when Phoenix market actually starts to improve, right? You're out of the summer, you're out of the worst time of the year. This is a time when the spring market comes early for the Phoenix market versus being in California where, our climate's pretty much year round. their market starts to pick up in the fall. So maybe they're holding out just to see what happens with buyer demand, see what happens with rates, and see if they can maybe hold on to some of that. Maybe not. We don't truly know. But what I will say is, if in most markets, if a seller has their home on the market over the next 3 months, right, they're probably motivated to sell because rates are higher, market times are longer, it's seasonality playing in, especially if they're owner occupied homes. People don't want people walking through their home during the holidays when they're sick and everything else, families over. So these are motivated people. So I tell you, if you're looking to buy a house now, look for the motivation. Look for the people that need to do something. That doesn't mean you're going to get some smoking deal. It just means it's a better opportunity versus, say, a more quote unquote normal market. Josh, do you know anything about septic tanks?
No, I know that it can ruin things. So my father-in-law, he has a detached garage, and it would be nice to put like a covered walkway in Olympia, Washington, where it rains almost 7 to 12 months out of the year straight. It would be nice to have a covered walkway there, and you can't do it because his septic is there. I'm sure that someone that lives in an area that is familiar with septic could answer this quite easily for you as to where it's located. And yeah, I don't have any
So the
insights.
question, just for those of you listening, not seeing it on the screen, says, how can you find out where a septic tank is in your yard? Want to build a fire pit, and before I start digging, want to make sure I'm not building over my septic tank. Help me. I think the easiest way is to get a bulldozer and just start like trenching the ground with it, and you will eventually find out where it is. That's the easiest way, Josh. Just go rent some big monstrous, piece of equipment and start digging. I think you're being shy if you don't want to hit it.
Only do it if you can put like a little torch on front of the bulldozer.
Oh, absolutely.
So that
you should be smoking.
you want
while
to light the
doing this.
methane as much as possible as you're trying to locate.
Do not do this lightly. This is you're taking it next level. Make sure you're videoing it as well, because that could also help the virality of this thing. I can't. Does that say libido? What is it?
Little bit of pure gold.
Oh, a little bit of pure gold. There we go. 6.1 on a VA mortgage. Have for my property. We have our farm property on the market for the last 3 months almost, and we've only had 5 showing. It's not the price, and the house is maintained. People are just not buying. Here's the deal. It's always the price. Always the price. As much as you don't want to hear that. Now, here's the thing. Maybe your price is accurate based on where the market is at the moment, and you're just waiting on the right buyer. That's fine. But understand, if you lowered the price to a point where it generated activity, then it would clearly be the price that was holding it up. So you don't need to lower the price in order to just let it go, but you've got to look and see what you're working with, right? You're working with a farm property. In my experience, a little bit harder to sell, a little bit harder to finance in some cases, depending on how many acres it is. So you might have some things working against you, but what you have to do is compare it to other properties in your area. Are other farm market properties selling? If they are, then you've got to look at your property and say, why am I not when they are? And if everything is sitting, then it's probably not your problem. It probably is a market problem. So, not to say you're wrong or whatever, but just make sure you're considering all sides of it. You do have, I guess 6.1 on a VA mortgage isn't really a great rate to assume. So it's not really, you can't really offer that because rates are lower than that at the moment on VA. But if you had a lower rate, or if rates go higher, then you might offer that as an incentive for somebody looking to finance.
Jeb, I want you to react to my reaction to this. I look at it and I say, okay, it's a farm property. So it's unique. This isn't a tract house that's in the middle of town. So you have a smaller audience of buyers, and it's been on the market for 3 months, and it's got 5 showings. It hasn't got no showings. It's got 5. And if we look nationwide right now, the average market time is about 4.5 months. So you're only about 2/3 of the way to the average market time, which includes very homogeneous, basic, simple properties. We don't know where you're at. So, it's easy to conclude people just aren't buying, but I can assure you people all day, every day are buying. They're buying in much lower numbers, but we're going to be somewhere below 4 million transactions when a normal year is at least 1 million above that. And a great year is 2.5 million above it. So it's definitely depressed, definitely less activity, but I assure you there's people out there buying. So back to your point that it is always about the price, it is, but with a unique property 90 days in, that's not unheard of. That
No,
hasn't
I don't
found
think
the
that's
right buyer
it's not
yet.
crazy. I mean, it would be like where I'm from, Eastern North Carolina, trying to sell a big farm property. Chances are it's going to take a while. You're going to have less showings. There's just less people interested in that type of living. I mean, where I'm from, right? Most people want to be in a little bit, even though it's still the country, a little bit closer to things, a little bit, you know, closer to civilization, if you will, to some regard. So you have to take all that into account and just, again, trust the process, trust your agent. Hopefully you do. Maddie, one of our regulars, came in and just said, appreciate us for sharing great content. Highlight of my Wednesday afternoon. We appreciate you being here. Matt owns a house. He's now a real estate agent. So, appreciate you supporting the channel, Matt. This one, Josh says, when refinancing, will the appraisal change the rate that the lender offers? So is there a rate before and after the appraisal? Can one change? How's that work?
It could, and it's very important that you're dealing with, and there's really not a way of you to know up front. Obviously, you wouldn't start a refinance transaction with someone that you didn't think is reputable. But part of our job is to make sure that if it's at a level where the loan to value is going to impact the potential pricing, that we're not assuming that the house is worth $100,000 more than you paid 6 months ago so that we can quote the best interest rate. On conventional loans, basically 75% and below is going to get better terms than 7501 and above. There are varying degrees of that, and it's going to vary by how high your credit score is. But the easy answer is 75 and below on conventional loans is going to get you the best terms or close to it. The other things to look at, FHA, VA, not going to make a difference other than cash out. You're not going to be able to go above 80%. At USDA, same thing. They don't have those loan level price adjustments based off of loan to value, but conventional loans, jumbo loans absolutely do. So the more your home appraises for, the better the terms are going to be. So if you call up some either dirtbag or dummy that goes, what does it look like at 70% loan to value? I don't know if our loan's at 70% loan to value, but he's going to like to hear that interest rate better, then yeah, you could be in for an unpleasant surprise when the appraisal comes in.
All right. Good question here. Josh says, when should I do the pre-approval? Hard credit check, question mark. Some lenders won't provide a pre-qualification without a hard credit check. Not ready to put in an offer yet. So Josh, will you do a pre-approval without a hard credit check? And if so, how do you do it?
So we have investors that offer us the ability to do a 3-bureau soft pull and then run the actual automated underwriting findings with that. And if you buy within 120 days, we can upgrade that to a hard pull and still use those same credit scores without having to risk getting a new one. But there are lenders that aren't set up to do that, brokers that don't work with investors that are able to do that. It's my preference for a number of reasons. We can give a commercial here for optoutprescreen.com. If you're thinking about applying for a mortgage at any point, please, about a week before, go out to optoutprescreen.com and opt out of all pre-screened offers of credit. Oftentimes when we do that hard pull, we'll hear from people, what did you do? I got 950 calls yesterday. And like, I'm not kidding, like 50, 60 calls. I think I've shown you, Jeb, the text messages that I've got from someone saying, this is my call log from my phone, like 50 long, because the bureaus will sell your information. So you don't want the inquiry. You don't want your phone blowing up. So the soft pull is sort of the workaround there. But if it's not a 3-bureau soft pull, if it's not a soft pull that can be upgraded, your risk is that it's a less valid or less solid approval. And in terms of when to do it, it is never too early, especially if you can do it with that soft pull, because we can do it absolutely zero impact. Hayden's buddy who wanted to refi, we think the numbers are there. He may want to wait and see what happens over the rest of the year. With that soft pull, we can see what the credit report looks like. We can run the automated. We can see if he gets an appraisal waiver, and then we decide to move forward with really no risk there. And that same thought translates over to a purchase pre-approval.
So Josh, if this person that we just talked about, I don't see what's the name here? I must have moved it. Oh, there it is. If they want to get in touch with you, or Christine here is looking for a good lender, how would she do that?
Well, you've got the little scroll right there, there below, of where you can input that information. It'll get it to our team. Someone on my team will reach out to you and we'll schedule a time to talk and go through all of those details. The most important thing is to get off on the right foot. So we need to get 5-10 minutes of your time just to hear, what are your goals? What are you wanting to buy? Where are you located? What type of property? How much money do you have to work with? What do you think your credit scores look like? What are your worries, thoughts, concerns in this process? Then from there, we can get you a very tightly tailored needs list. So complete this online application, take 7 to 10 minutes, get me these 3 or 4 pieces of documentation, and we can get you a rock solid pre-approval so you know exactly what you can do with the comparison of a couple different loan programs and cost structures.
Yeah, and that's jebsmith.net. So jebsmith.net/referral. That'll get you to that page where you put in your information. Josh's team will reach out and we'll get you connected. So Josh,
I always forget, Jeb, some of these people are listening on the podcast
They are.
to this.
They
and
are,
I'm not reading. I tell them to look at the bottom of the screen. Like, I'm not on a screen, dummy. I'm in my car.
That's fair. That's fair. So we're just going to throw it out there. Like, all podcasts always say the thing and then give their offer code afterwards. So maybe we should start doing the same thing. ZL says, what's an average break-even period for a VA refinance? Got a quote going from a 6.5 down to 5.25. So 1.5%. They're asking though to pay 1 point, which is an $8,000 total. So that means loan amount's $800,000, Josh. Oh no, 291,000. So 1.8.
So 8,000 total closing costs. The 1 point is going to be about $3,000. There's 5,000 of additional costs there.
I missed the total closing costs. So 44 a month, break even seem high. We actually talked about this today, Josh. So would you pay points right now? And what is what are you thinking with break even?
So I would not pay points. And that's based off of my belief that we let off the top of the show that we are going to see better interest rates. So where this calculus sort of changes is exactly in this situation. 291, it's a smaller loan. It's not a small loan. It's not $100,000 or $150,000 loan, but it's also not a $600,000 or $700,000 loan. What I would want to make sure, when you say $8,000 of total closing costs, the government in their infinite wisdom on the loan estimate lumps prepaids and loan costs together and calls them closing costs. You are going to pay your prepaids, prepaid interest, property taxes, homeowners insurance, whether you take that loan or not. So I would want to make sure that $8,000 in total closing costs is coming from box D, which is the total of box A, B, and C, which are the loan costs. So take the total in box D, divide that by your monthly savings. That's going to tell you your break even. Now, I told you, Jeb, you and I were having this conversation earlier. I was reading an article from a very accomplished loan officer telling other loan officers how they should be handling their database and helping as many people as possible to take advantage of the lower interest rates. And he said, in my book, anything 20 to 30 months or less on the break even is good. And I'm like, that's kind of crazy. We generally talk and think in terms of 6 to 12 months. But the reality is 6 months or less is a no-brainer. If you can recoup it in the first year, just go ahead and do the damn loan and move on. Now, at 1 to 3 years, you have to start asking yourself, what do you think is going to happen over the next 1 to 3 years? And am I willing to pay that cost for insurance that rates don't go higher, or I don't get this opportunity over the next few years? So when I look at that, I want to say, look at your savings. Tell me how much that cash flow means to you on a monthly basis. Like, I have clients where you look at it, you go, hey, we do a no cost and can save you $200 a month and keep your loan term the same. And they'll go, oh, $200, not really worth it. I have other people, you tell them $200 and they're like, oh, hell yeah, where do I sign? How fast can we close this? So you have to know your perspective, your household budget, all that stuff, and how much you value the cash flow. So the break even, I would love to see it less than a year. If it's anywhere from 2, maybe 2.5 years, you can certainly justify it, especially the greater the cash flow savings there. So make sure you're looking at the right thing in terms of closing costs and not looking at the figure from the LE. Thing. You're looking at the left side of your loan estimate and really box D. Box E you could include in there also, but really just look at box D divided by your monthly savings. So these are the things that we're going through with borrowers right now. I talked to a listener here earlier today in Georgia, and we could do 5.25 on their FHA if he pays a point. And we're like, why would we pay a point? There's a really good chance we're going to be redoing this in 6, 9, 12, 18, 24 months. And that it was a similar loan size, like 275 No, it's 315. So like 20,000 higher than this loan. And that 0.5% made a $75 difference in the monthly payment. So we're sitting here, what would you rather have? $3,000 additional cash out in your loan or a $75 lower monthly payment? He's like, yeah, $75 doesn't mean anything to me. I do not want to pay that and have that sunk cost that might prevent me from refinancing again in the next couple of years.
All right, good stuff. A couple questions here. Not sure we're able to answer, but says just switched to landlord insurance on my first single family rental. Is $300K in liability insurance a good enough amount? Hard to say, right? To each his own. I don't know what you need. Josh, what do you need on a rental property?
So
in liability?
here's my answer. And I literally, while you were answering another question, I pulled up my policy. I have 500,000 of liability coverage on all of my properties, and there's a reason for that. I have an umbrella policy with $2 million of liability coverage, and they make you have 500,000 of coverage, and they only kick in. So it's 2 million of coverage, but they don't kick in for anything under that $500,000. So I would highly recommend an umbrella policy. I wish I had pulled that up to see the premium. I think it's like $400 a year for an additional $1.5 million of liability coverage. And I think that's pretty universal that they make you have the $500,000 of liability coverage to be eligible for it.
There you go. VAG or VAJ Sports says, is it hard to refinance a loan over 1 million in Virginia? And the answer is no. But it depends on the scenario, right? Just like anything else. If you meet the qualifications, it's not hard. If you don't meet the qualifications, it's going to be really difficult. So we need a little bit more information. If you want to provide that, Josh is actually able to do business in Virginia. So you can use that referral link scrolling the bottom there, jebsmith.net/referral. And Josh can connect you and talk to you and help guide you through that process. Nelson says, what's better on a new build priced at $250,000? I'm going conventional with 10% down, but heard FHA is not bad as well. So Josh, if you have a borrower who's putting 10% down, they're considering between conventional and possibly FHA, depending on their credit scores, I would assume. How do you help them decide what's the best way?
At 10% down, unless you have serious issues with your credit, a 650 credit score, which would still get a very good FHA rate, not going to get the best conventional. So at 10% down, you're getting lower mortgage insurance. You're going to pay a higher interest rate on that conventional loan, but you're going to have lower mortgage insurance that can be removed. The payments are going to probably be pretty similar between the two of those, but you're avoiding the upfront mortgage insurance premium on FHA. To the downside, the conventional loan does not have a streamlined refinance option. So the ability to do no income verification, no appraisal required refinance, there's a value in that. But for most people, it's not a deciding factor in coming to this. So if you have a credit score above 680, definitely above 720, 740, with 10% down, you're going to be looking at the conventional loan. And that's not in any way to say anything bad about an FHA loan. The FHA loans are very, very good. But if I showed you a side-by-side comparison, you'd probably look at it 99 times out of 100 and say, I want to go with the conventional.
There you go. Good stuff. Bill is asking about the election and interest rates. Just says, how fast does the market move, specifically mortgage rates, once a president is elected? Probably not as fast as you want them to move. Understand what impacts interest rates, right? We talk about it all the time. Mortgage-backed securities, more importantly, the spread between the 10 and the 30-year, the 10-year, all of these things impact where mortgage rates are today. Is that likely to have a big drop the day after or the day before? I mean, maybe the volatility pushes it, but my guess is it would be something that would not hold in either direction regardless until you got more fundamentals, more of a foundation that says why rates are moving one direction or another. What's going to move interest rates and hold interest rates are changes in unemployment, changes in inflation, the things that we talk about consistently here. The change in presidency isn't going to impact rates like a lot of people want to believe it is, at least in my opinion. It's more of all the underlying fundamentals that go along with the economy that's going to impact rates. Josh?
For those of you who want to make this political or an endorsement, in 2016, we had the first half of 2017 rates went up. And that was because Trump had the presidency, both sides of the House and the Senate, and he was able to push through his tax changes. So it was spending that wasn't offset. It led to rates going up in the short run. So long way of saying, if you want lower interest rates, you don't need to be rooting for a candidate. You need to be rooting against either candidate getting both houses of Congress. As long as we have the split that we've had for the last 4 years, politicians, presidential candidates can come up with wonderful ideas. They're not going to get them through Congress. And that was sort of the founding fathers' idea, that they wanted to prevent one side or the other from coming up with crazy harebrained ideas and ramming them through. So if we get a divided presidency and Congress, you don't have a whole lot to worry about. Exactly what Jeb said. It's going to be the economy that dictates where rates go.
There you go. We got a couple here. Tyler saying, hey guys, recently closed on a 4-3 in a new development that is continuing to build several similar homes in the same neighborhood. What effect would this have on my home value? Thanks. It depends. I mean, typically builders don't like to hurt themselves in the sense that they don't want to sell homes at a lesser price after they've already sold homes in the community at higher prices. So in theory, every home they sell from when you purchased your home is likely going to be at the same price or higher. Now, obviously, the market dictates where some of this stuff goes and the direction it goes and how they keep prices higher. Sometimes they buy down rates. They do things to make it more affordable so that the price still sticks on, paper, if you will, doesn't hurt the sales and all that stuff while still getting the transaction to go through. So hard to say, right? We don't know the neighborhood, don't know the area, don't know where we're talking about in general. But I would say, typically speaking, when you're talking about newer developments, new buildings, the earlier you purchase in that cycle, the better off you're going to be long term, right? Without knowing everything else. So I would say just hold tight. I mean, you just bought. If you did everything we said, you have that longer term time horizon, got money in the bank, you're comfortable with the payment, live your life. Look back in 10 years and be glad that you bought a house. All right. Josh, Rokesh's buddy is buying new construction. He's got to get a construction to perm loan because it's a small builder. Is there anything he should watch out for? Do you know anything about construction to perm?
I'm not going super far out on a limb on this. We don't come across many construction loans in California. If I were to have one, we have a couple guys in our office who are experienced in them that I would go to. This is highly unique that you would be taking out a construction loan with a builder. Where this typically happens is when I want to build a home, I find a lot, I get my plans, I go find a builder, and that's on me. They're building a spec home for me. If this is someone that's building 10 homes and they go, cool, I'll build it, but you need to take on the risk of the loan. It's going to be a little bit more expensive. It's going to have a higher interest rate at the start. Many of them have it's not really a float down, but once the construction period is over, they'll recast it and reset it. How much money did we actually spend of the construction funds? What's the current market interest rate? So not going to be a huge help to you on this one, just because it's a bit of a blind spot, but it's absolutely unique if it's not a situation where he found his own land and made his own plans and then went and found a builder.
And I got nothing for you. So whatever Josh told you is the best advice I can give you. Connor is asking, can you give perspective to, rather than putting in a lower offer, having the seller buy down the interest or request money back as a concession? Is this a viable way to lower the monthly payment? Sure it is. But here's what I would ask you, Connor. Do you think rates are going to continue to trend lower? Do you think that you'll be in a position financially, employment-wise, to refinance if and when rates move lower? If that's the case, then wouldn't you rather have the home at a lesser price, maybe a slightly higher payment now, be able to take that opportunity in the future, refinance, take that rate down, right? Because it's based off the purchase price, and have a bigger impact, rather than have the seller pay money towards a buy down or towards something which is a sunk cost. And then if and when rates go down in the future, you still have the same purchase price that you could have had lower had you used that money differently. I'm not saying I'm the right answer. I'm just asking you to think it in a different way, right? Because everybody thinks monthly payment, right? People live in the payment and not the price. Unfortunately, fortunately and unfortunately, the internet will tell you that everybody on the internet leads to believe that price is more important than payment. And they are all right. But the problem is nobody actually follows that advice, even the people that are saying that. So if you believe that payment or price is more important over the long haul, try to get the price lower and then work in the future as rates go lower on hopefully taking advantage of a lower rate. Anything you want to
Here's
add to that?
yeah, 100%. It's what is more important to you, the monthly payment or equity in your home? The sale price and the future sale price are a different thing. But if we assume that we pay $10,000 less for a home, we will have $10,000 more equity going forward, no matter what it appraises for. But if we want the lower monthly payment at current interest rates, about $1,000 of loan costs you about $6, a little less, a little more. So $10,000 saves you $60 on the monthly payment. If it's a $500,000 loan and we're getting 2 points, it's going to save you 0.5%, maybe even 0.75% in certain situations. And it's going to be a much, much bigger difference in terms of the monthly payment. So exactly what Jeb said is right, but you got to quantify it in the moment and say, what is more important to me? That lower monthly payment, which a seller contribution to buy the rate down, will make a much bigger difference than the seller decreasing the purchase price for you.
Absolutely. No, it's all about right now, right? I mean, but again, the question I'll ask is if rates go down in 6 months and you can refinance and take advantage of that same rate today, which had you rather have, the lower price or that slightly lower payment for that $60 difference in payment for the last 6 months?
Yep.
Whatever. I'm not the right answer. I'm just opening, hopefully, your mind to other possibilities out there. With that, Josh, I'm just reading here. Okay,
Let me
we'll go
just
with
throw,
this. Yeah, well, is this the one you were going to click on?
no, go with it.
Okay, so Bill was pre-approved by a lender for a USDA loan, but after getting an offer accepted, the lender notified me that the USDA would not approve the initial pre-approved amount. Is this normal? $60,000 difference. So my guess is appraisal is short. Josh, what do we think here?
I wouldn't change your approval. You'd still be approved. You just
Oh
have to
yeah,
come in with money. So he's saying, is this a normal practice? Well, what this reminds me of is what we recorded this morning for the podcast next week, how your lender that you're working with can cost you money. No, there's never been any world in which I've pre-approved someone for a loan and they go get a property and then we submit it to underwriting and underwriting goes, hey, dummy, you were off by $60,000. Does it happen? It happens all the time. We get questions here. We get questions in our inbox. And it's just a matter of who you work with matters. So the number one question that we get by a 10-to-1 margin when someone is inquiring using that link there at the bottom is, I want to make sure I'm getting the lowest interest rate. No one ever says, I want to make sure I'm dealing with a professional. I have a smooth and stress-free process and I don't have to deal with bullshit like this. But many of you do, because the question that you're asking is, how do I get the rock bottom lowest interest rate quote? You don't know that you're going to get it until the very end to begin with. But it's too important. I'm not saying anyone should pay a premium to work with the greatest loan officer in the history of the world, but you also can't go to Walmart and expect you're going to get high-end services or goods.
Well, that's bullshit, dude, because I do expect that from Walmart.
You and the people of Walmart.
Well, here's the deal. Great website, by the way. I'll play devil's advocate. Perhaps Bill got pre-approved when interest rates were at 5.85%. And now rates are 6.5%. And so that changed his pre-approval amount. Could that
wouldn't
be a
change it
possibility?
$60,000. It would change it, but it wouldn't change it $60,000.
All right, fair enough. So Bill, if you want to talk to Josh, there's a referral link at the bottom there. If you don't want to talk to Josh, you want to talk to somebody else, then reach out. We can make that happen too. Let's see here. We got a question here. It's kind of a vague question. It just says wholesale rate lenders ? Any thoughts? Don't really know what that means. I'm assuming, does that mean that work with a wholesale lender, Josh, like a broker? Do you go to a wholesale lender? What do you think about wholesale lenders?
Yeah. If anyone is telling you that you're in good hands with me, I'm a wholesale rate lender, just go get someone. We have access to wholesale rate sheets. We have 100 investors. I've told you guys we have about 70 different investors to pick from. And any program, we're going to go see all of the investors that offer that and who has the best terms and is awesome for you to deal with and me to deal with. So that is the deciding factor. So if I say, I've got wholesale rates, well, cool. Even a retail lender like a guaranteed rate, they don't have wholesale rates. They get correspondent rates and they have 3 or 4 or 5 different investors for every program. And their rate sheet is kind of cobbled together at every different note rate and scenario of who has the best terms. So it's somewhat meaningless. And every time someone has told me that someone told them this of why they're in good hands or should be working with them, it's been sort of the opposite case.
They weren't in good hands.
They were not.
Jessica has a good question here. This is a question that comes up not as often as it probably should. But I mean, just in general, says, is it worth a slightly lower rate with a lender that is known for selling your mortgage, or go with a slightly higher rate with a lender that holds on to your mortgage? What's the risk versus reward? At the end of the day, you shouldn't care who holds your mortgage. I don't care if Josh holds my mortgage. I don't care if you hold my mortgage. At the end of the day, the mortgage payments due. It doesn't matter, right? It's just whoever holds the servicing rights of that mortgage. So Josh, is it possible that you get a slightly better rate for somebody that sells your mortgage?
No. So here we've talked about United Wholesale on here before, and they have a thing. I forget what they call it. It's like rate lock or client protect or something. And what they will do for a slightly worse rate to the borrower, if you're brokering, or for us non-Del, slightly worse pricing to us, they will guarantee you that for the first 36 months, that loan doesn't get sold. No one is going to guarantee you that for 30 years.
Who cares?
So unless you're going to like a credit union, and the credit union legitimately tells you, we have never sold a loan, you do not have the certainty that it is never going to get sold. And then we fall back to Jeb's more important question of who cares? They can't change the terms. There's really only a handful of lenders. After 2 months here of looking at loan estimate after loan estimate, mortgage statement after mortgage statement, 90% of them come from 3 or 4 different servicers. All roads lead to the same destination. You are likely to end with one of them, whether you like it or not.
Yeah, and at the end of the day, it really shouldn't matter who your mortgage is with. Your payments still due at the same time. The terms are the same. It's all the same. Maybe one's system is a little bit fancier than the other, but at the end of the day, go with the lower rate. If they're telling you that gets you a lender that sells it, doesn't matter. It's all the same.
Jeb, I've got a great question for you.
Let's hear it.
Rao Abbas says, if a house is listed for $300,000, what would be a good offer for my all cash purchase?
$300,000.
Why am I not getting a discount? I mean,
because I don't know the property. I'm thinking that property just came on the market today. It was priced at $300,000. The seller priced it correctly. Therefore, you make an offer at what the property's worth. No, in all reality, there's way more information we need. But here's where I think cash buyers are wrong. Your cash purchase means very little to the seller unless the seller has a motivation to do things very, very quickly within a couple of days. And the reason I say that is because the seller doesn't get cash. They don't walk into closing and get a briefcase of cash. They get a wire into their bank account. So whether it's a cash transaction or a loan transaction, at the end of the day, it's more or less the same. When does it matter, I guess, is the better question. If appraisal could potentially be an issue, and with the cash offer, you're not doing an appraisal, a fast close, those are really the only 2 times when cash is more of an issue. I mean, or more of a pro, if you will. You know, I talk to sellers all the time where there's cash offers, and we talk, one versus another. And I tell them, hey, the money's the same at the end of the day. This cash deal is not any better than this loan unless the terms are equal and or better in some cases. So, and there's a belief out there that you can come in with cash and underquote and lowball and whatever and get your deal because you got cash. I'm telling you, as an agent that deals with a lot of sellers, we tell those people to pound sand. So not to say that's the case here, but you got to look at the market and see what the market's doing. Probably not the answer you wanted, but it's the one I'm giving. Josh, we got Daniel saying, is it the right time to refinance a $490,000 loan with a 7.449 conventional interest rate?
Okay, so there's a bunch of more information that goes into this. The 2 big ones we don't know is the loan to value and the credit score, but you should be able to look at $250 to $300 a month savings with no cost. So all of your costs getting covered or close to it if you're in a high closing cost state. So use the link below, jebsmith.net/referral, and you'll get connected to us in about 25 of the states and David and his team in the other 25. And we can easily go through the numbers. And the important part is if you look at it and you go, oh, well, as of today, it's a $240 savings for a no cost, or if I pay $5,000, it's $350 savings. I'm not ready to pull the trigger. The discussion that we can have is, what is your target rate? Where is the monthly savings that you have to get? I had this conversation 2 nights ago with a listener in Ohio, smaller loan. And they were like, we're going to get that thing back to 6.125 with 0 points to us. So right now they were at like a half point. So they're not far from it, but we need to go and have that conversation. In your situation, $490,000 is a good sized loan. 7.5 is a high interest rate relative to even where the market is today for people with good credit and a chunk of equity in their home. So my guess is, yeah, it absolutely does make sense. But even if it doesn't, you need to have that conversation today so we can get you on that strike price list where you're going to get notified when rates move back down to that level. Jeb,
So two things just happened, Josh. We made it an hour. Two things happened. One, the audio went out on your side for a good 5 seconds. The second thing is you turn your lights on. You almost made it through an entire episode without screwing up, dude. And here we are, back to the same old Josh, unfortunately. No, we got 2 questions. We're going out. Lord Sinclair. Josh says, not Sinclair, it says Sniphar. But we're going to go with Lord Sinclair. I like that better. It has a better ring to it. I'm being quoted 5.62% on a VA loan. How competitive is that today? So, Josh, how competitive is 5.62%? I guess you need to know what they're paying. A lot of things, right? Credit score. I guess credit score is not so important on VA, but what do you need?
That should be 0 points today with minimal lender fees, assuming good credit. So again, like you said, we need to know the credit. We need to know where the property is located. We need to know what the loan amount is. We need to know how much they're charging you. So out of context, yeah, it's fine. So, from that perspective, hopefully that's enough for you. Jeb, we got an interesting one here. So Marco says, I got approved for a 6.5% FHA loan. I make $100,000 a year. In order to make my payment feasible, I need a $220,000 home. Or should I wait for interest rates to lower? You should use the link below and get connected either to my team or David's, because 6.5 on an FHA loan is awful today. So today rates are much lower than what you've been quoted. So unless you have a 580 credit score, 6.5 is not there. And I'm going to push back on $100,000 a year. That's $82.50 a month, $83.33 a month, somewhere in that range. So you're being prudent there, but that's pretty darn conservative, saying I can only afford a $220,000 home at a 6.5% interest rate. You can absolutely get qualified for more, but it leads us back to that question, Jeb. We always tell people, I can't tell you how much you can afford. I can tell you how much you can qualify for. So it is far more important what you feel you can afford. But unless you're in a really, really high property tax state, I have $100,000 income households buying $350,000, $400,000 homes. So use the link, get connected to one of us, and get a much better interest rate quote, and have that conversation in depth of what moves the payment to get you where you feel like you need it to be. $100,000, you can absolutely afford to be a homeowner.
So this is a question, Josh, we've never received. Are lenders willing to negotiate mortgage insurance if you have perfect credit? Are they willing to negotiate at all?
You don't have to negotiate. You don't have to negotiate it. The credit score is factored into that. There is no negotiation. Fannie and Freddie say, with this loan, at this loan to value, you have to have this amount of mortgage insurance. We need 0.12, or we need 25% coverage. We need 35% coverage. And then based off of your credit score, the number of borrowers, the property, the location, that translates to an interest or an MI rate. The MI rate is not negotiable. No one is changing that, but the terms of you and the scenario are going to dictate what that MI rate is. So very well qualified borrowers are going to pay a much lower MI rate than an unqualified borrower, but 2 very well qualified borrowers, one is not going to negotiate a better MI rate than another.
All right. Marco came back and said he's in Tennessee, has a credit score of 712. So Marco, you should definitely reach out. But if you found any value tonight, guys, do us a favor, hit that thumbs up, subscribe to the channel if you haven't done so already. Until next week, guys, buy right, borrow smart, build wealth. Adios.
Amigos.